Good morning, everybody. Thank you for joining us and welcome to today's F Street Investor Roundtable. Today, we're going to talk about everyone's favorite topic, taxes. So I'm going to introduce you first to our team. First is myself. My name is Jordan Lynch. I'm the Director of Finance here at F Street. I also have Heidi Blizzard, who's an accounting associate who helps with our all things accounting and finance on our side. Heidi and I are not tax advisors, but we do work hand in hand on a regular basis with our external third-party tax team to ensure that all tax compliance is done timely and accurately, and that we're appropriately taking advantage of all tax benefits that we can then pass through to our investors. So the first thing we're going to discuss is Form Schedule K-1. So first of all, the question is, what are Schedule K-1s? Schedule K-1 is an IRS form that's issued to investors for investment in a partnership. For those of you who are current investors in F Street development deals or prospective investors in F Street development deals, these are applicable to you. All of our deals, development-wise, are structured as LLCs, which are taxed as partnerships. In those cases, our investors, once we are generating taxable income or losses, will receive Schedule K-1s on an annual basis. The Schedule K-1 provides the individual investor with the necessary information to accurately report their income or tax liabilities to the IRS in their individual tax returns. Said another way, the Schedule K-1 takes the tax outcomes of the partnership, passes them along to the individual investor. So each individual investor is able to report their share of income, loss, deduction, or other tax outcome from the partnership in their individual tax returns. These, as I mentioned, are used for reporting on our equity investments in our F Street development deals, both ground up and acquisition. Why are they important? As I mentioned before, these are pass-through entities, which just is a simple way of saying that any of the tax outcomes that are experienced at the LLC or partnership level do not require tax liabilities or tax payments to be made at the partnership level. All tax outcomes are passed through to the individual investors via the Schedule K-1. This is unlike C corporations, which are taxed from a state federal level at the corporation level. And then when the dividends are paid out to the investors, those dividend incomes are again taxed at the individual level. The benefit of the pass-through organization, like a partnership or an LLC, is that they are not subject to dual taxation. Yes, that's a great point. So it's important to note, as Peter mentioned, if you invest in multiple entities with F Street or multiple deals, you will receive one K-1 for each investment in that deal. Every deal is its own LLC, meaning you will receive one K-1 for that entity every single tax year. Yes, absolutely. So whether you're a Class A investor or a Class B investor does impact the tax outcomes. Before all capital and principal is returned, the share of pro rata income will be split differently if you're a Class A investor before and after all capital is returned. All right, so moving on to 1099 INTs. This is a different form that is issued for current or prospective investors in our private debt fund or promissory note products. So unlike Schedule K-1s, which are issued for investments in a partnership, 1099 INTs are issued for investments in our private debt fund or promissory note, which is a simple form, as you see here on the screen, that reports your share of interest income earned in the year. This, similar to a Form W-2, just simply reports what you've earned that year. You can compare it to your individual records. Some of you may keep very detailed records, which is a good thing. You can think of this more like a check to make sure you've appropriately reported all of your interest income for the year. However, it is a very important document to make sure you're keeping an eye out for on an annual basis for your investments in the private debt or promissory note products so that you appropriately report it in your individual income tax return. Yes. If you are receiving interest on a compounding basis, you are still responsible for your tax on an individual basis. That is the case for both private debt fund and promissory notes that we issue. Moving on to our next topic, we're going to discuss a tool that we use in our development deals called cost segregation studies. So what is a cost segregation study? What a cost segregation study does is it identifies components of a building and reclassifies it. Said another way, if you think of an acquisition or a ground-up deal, you're treating the assets as individual components as opposed to one singular building. The reason that's important is because buildings are depreciated over a very long period of time, 27.5 to 39 years, depending on the nature of the building. If we do the work of having a cost segregation study done, we're able to allocate the individual components of the asset out. You think of things like carpeting, furniture, fixtures, sidewalks, other improvements that are depreciated on a much shorter time period, which allows us to take depreciation expense earlier on in the deal, lowering our tax liability earlier on in the deal for our investors. Why is that important? It increases your short-term cash flows. Short-term cash flows are obviously a bonus for obvious reasons, but also from a time value of money standpoint, anytime you're able to defer your tax liability to a much later date, you're getting the benefit of having that cash flow now, which you can take to invest in other deals or put to use in other things that you might need to use that cash for rather than having it paid out to Uncle Sam early on in the deal. How do we do cost segregation studies? So for anytime we have a new deal, whether it is a ground-up development or an acquisition, we will engage a third-party accounting firm to perform an initial analysis as to whether or not it's feasible and beneficial to us to go through the cost, time, and effort of having the study done, and whether we'll receive the sufficient tax benefits for this to be beneficial to our investors. Once that initial study is done, if it provides the desired tax savings based on the investment thesis that we have, we will go forward with the study. The fees associated with that study are built into the budget of our projects, and then the tax savings from that cost segregation is passed along to the investors, and it begins to be realized as soon as that asset is placed into service. Why is that important? For our ground-up development deals, the placed into service date can be 12, 18 to 24 months after we begin the project, because you are not be able to deem the asset as placed into service until it's available for rent to a potential tenant. For an acquisition deal, the asset can be deemed as placed into service as soon as the property is acquired, which will mean you could take advantage of the tax benefits right away in the year of acquisition. Yes, so we had an industrial deal close at the end of last year and some industrial deals that we're working on this year that are acquisition deals. And for those, you are able to take advantage of the tax savings in the year of acquisition because they're available for service and placed into service immediately when the acquisition occurs, meaning that all that depreciation that we've moved up earlier in the deal, we can start taking advantage of that from a tax perspective early on in the process. Another important thing to point out with cost segregation studies is that you can generate tax losses in certain instances despite the fact that you're generating cash flow from your investment on an investment in an asset that's appreciating in value. You're kind of getting the best of both worlds. And if you have a portfolio with other passive income, you're able to take that passive loss that you're getting from the real estate investment and offset some of that passive income, lowering your individual tax liability in your return. So I also want to take this time to reiterate our commitment to you, the investor, from our team specifically. Our team's responsibility and commitment to you is that we will provide clear, accurate, timely financial reporting to you and to the tax advisors that we advise with to ensure that we are taking advantage of all the tax strategies that are available to you as an investor. those tax benefits can lead to you having a much more desirable outcome, increasing the return on your investment as an investor. We're always here to maximize your investment returns. I also want to reiterate that we are always available to answer any questions that you have. As an investor in our businesses, it is important to us that you feel that you have the appropriate transparency into the businesses that you are invested in. We are happy to answer any questions that you have, provide any information that you need to help you better understand what you're invested in. You can always reach out to myself. My email is Jordan, Jordan, @fstreet.com, or any of our team members who can refer you to me to answer any questions that you have about your investment with us. Now we're going to take a brief moment. Should any of you have any questions, please raise your hand or submit your questions in the chat, and we're happy to answer those. Yes, Rob mentioned in the chat that he has not received his 1099 yet for his IRA. Our member of our team will reach out to you shortly thereafter to follow up on that. And another question that's been received is regarding the timing of K1s for our investors. It's a great question and an appropriate time to have this discussion. Our tax advisors and our team is working very hard right now to ensure that we're able to get all Form 1065s and Schedule K1s completed and distributed by the initial deadline of March 15th of this year, which is a couple weeks away. So all external investors can expect to receive their Schedule K1s by March 15th, which will then give you another month of time to complete your individual tax returns, which are due a month later on April 15th if you're not extending your return. Yes, I think it's an important thing to reiterate that I myself and Heidi and our team, we are not tax advisors. However, we are financial professionals that'll help you better understand your investment. And if you do have a tax-related question, we're happy to put you in touch with our tax advisors to get into the intricate details of your tax implications of your investment with us. All right, we're going to stick around for a couple more minutes in case anyone has any questions. But if not, I want to thank you for joining us this morning. You're always welcome to reach out to us offline with any questions that you have. But we'll stick around for a few more minutes, and I hope everyone has a great rest of their day. Thank you.